In this video, I'll discuss the 4 significantly important lessons that I've learned from my mistakes while being on my investing journey so far. Some of the lessons I've learned have been tough, but I feel like I've become a better investor because of them. I'm hopeful that by passing on my experiences, you won't make the same mistakes that I did, and again, hopefully speed up your own learning curve. I did a video recently where I talked about my first 2 years of dividend investing, where I am currently, how much I've made, and the experience that I've had so far. I'm doing okay, but I've never claimed to be an expert, and definitely don't consider myself a guru. I'm just a normal person that's interested in putting my money to work, rather than leaving it sat around doing nothing. But during this journey, I have made mistakes along the way, and in hindsight, I would have done a lot very differently. But I am using these experiences as part of my learning curve. I'm a firm believer in learning through experience. You can read all the investing books in the world, watch everyone's YouTube videos, and view a multitude of tweets and Instagram posts, but nothing will help you more than taking action and starting your own journey yourself. For me, a cycle of attempting, failing, adjusting is the best way to learn. I am a fully qualified accountant, so I guess I do have a certain level of financial expertise, but I'm on a journey where I know that I'll have wins and losses and ups and downs. And through this channel, I'm going to share everything with you. So, in no particular order, the first thing I've learned is to have a strategy and stick to it. Are you going to focus purely on growth stocks? Are you going to focus purely on dividend stocks? Are you going to focus purely on index funds? Are you going to have a mixture? What ratio does this look like? Are you going to diversify? How are you going to diversify? What is your ideal number of stocks to own? Are there certain metrics a stock needs to hit for you to consider investing? These are all questions that should be answered in your strategy. Initially, for the first couple of months, I felt like a kid in a sweet shop when it came to choosing stocks. I was all over the place and didn't really have a clear vision of what I wanted my portfolio to look like. I've since sold around half of the stocks I initially bought, as I look to trim down my total holdings. On a similar note, don't chase the latest fad. Avoid FOMO when stocks start rocketing up. I've seen the euphoria around GameStop and AMC, and it's only natural to look at some of the amazing gains being made and be a little jealous. However, investing in assets that I don't have an underlying conviction in is more akin to gambling rather than investing. And usually, once a stock is making huge moves, you're already too late. Of course, your strategy can change and evolve over time, as mine definitely has, but try and avoid a scattergun approach to buying stocks. There is a real trend online currently, where everyone seems to want to predict the next big thing. People will recommend stocks and make outlandish claims that it could 10x, 100x, 1000x. It seems to be very egocentric driven, and they'll forget the hundreds of times they were wrong and claim to be a genius for getting one prediction correct. But just be careful that you don't just jump in and buy based purely on the recommendation of some stranger on the internet. I include myself for that matter. Just because I'm buying a certain stock doesn't mean that you should. Always, always, always do your own research. You really do need to develop your own method for screening and searching for stocks. The second mistake I made was not keeping my emotions in check. Currently, I don't have to look at my portfolio every single day, and I tend to sleep better because of it. This isn't an advert to ignore your stocks, but it's a quick reminder that if you buy for the long term, then you don't have to sit on the edge of your chair watching your stocks tick up or down 2 pennies throughout the day, which is what I did at first. Stock prices go up and down all the time, often for bizarre, irrational reasons. So, rather than panic over an investment's short-term movements, it's better to track its big picture trajectory. Have confidence in an investment's larger story, and don't be swayed by short-term volatility. Where possible, try to recognise your emotions, and then try to make sense of them in a rational, thoughtful way. When I'd put money into a position and then see the price drop not long after, it did used to cause me some stress. But now, after rationalising, I've learned to realise that price volatility is actually an opportunity to scoop up cheaper dividend income. I buy the majority of my stocks now on red days. I personally think that a good investment philosophy is one that lets you reduce the time spent thinking about your investments and lets you go about your daily life. If you are waiting for a stock to hit a certain price, either to buy or sell, utilise price notifications, where you'll receive an indicator once that price hits. Or alternatively, set limit orders that will execute once your target price hits. Obsessing over stock prices all day is no way to live your life. Mistake number 3 that I made is not looking beyond the numbers. Don't just invest in a company because of their dividend yield, their market cap, their dividend frequency, etc. I was very guilty of buying stocks based purely on their metrics, sometimes even buying companies where I didn't even know what industry they were in. It is important to look at the numbers as part of your search criteria, but I think you also need to go beyond the quantifiable metrics and look at the business from an external viewpoint. What I mean by this is that investing isn't just a numbers game. Remember that when you buy a stock, you're buying part of that underlying company. You can be a better investor and reduce your risks by taking a little bit of time to understand the company. This is easily done by visiting a company's website and reading its annual report or some of its investor presentations. Don't invest in a company whose business you don't understand. At the end of the day, we need to remember that companies need profits and cash flow to pay dividends. This comes from selling products or services to customers at a competitive price and having plenty of money left over after all of the costs of providing them have been paid. It's a good idea to try and understand how a company makes its money and ask yourself whether it can continue to maintain or increase its profits in the future. Don't buy a stock if you cannot clearly articulate how the company makes money. Once you are able to articulate this, then it's your job to understand the various levers of growth which may impact revenues. The fourth and final thing I've learned is to start now and be consistent. I delayed starting investing for much longer than I should have done. I was worried about making the wrong decisions and losing my money. But starting was the best thing I've done, as it's meant I've been able to learn as I've gone along. I've yet to meet anyone that has a 100% win record in their investments, so don't worry too much if you ever feel like you've made a bad move. Consistency and patience are key. It's a long-term game. Consistently invest each month in stocks you have conviction in, and be patient. With dividend investing, you won't get overnight results. And it certainly isn't a get-rich-quick scheme. Remember that you can't start at the top. It's highly unlikely that you can suddenly start with a multi-million-dollar dividend portfolio. But the sooner you do start, the sooner you can start receiving dividends, and the sooner you can then reinvest those dividends and let the magic of compound interest do its work over the long run. I try and invest at least £500 each and every month, and I treat this as my investment bill. I know that I have to pay my mortgage bill, my phone bill, my council tax bill, my internet bill, so for me, I class my investments as a bill that I also have to pay. This way I've conditioned myself into believing that I don't have a choice but to apportion out some of my salary into investments every single month. And the more that I can invest each month, the more that I'll receive back in dividends, and therefore enhance the velocity that the compounding effect can start to snowball. I have made mistakes, but also learnt a lot in my years of investing, and I'm really glad I started. As a quick recap of what we've just discussed, number 1, have a strategy and stick to it. Number 2, keep your emotions in check. Number 3, look beyond the numbers. And number 4, start early and stay consistent. I'm sure many of you have also made the same or similar mistakes, but don't beat yourself up or be embarrassed about them. As long as you've learned from the mistakes and have improved your investing know-how, then view it as a positive thing. I'm really excited about seeing what my portfolio looks like in another year, 5 years, 10 years, and beyond. And I look forward to sharing my progress with you through this channel. Now that I've run through my own experiences, I'm really interested to hear what investing mistakes you've made during your own investing journey. Drop them into the comment section below. I hope that you've found this video useful and informative, and I hope you've been able to take away some value from it. If you have, then please like the video, as the engagement and support really motivates me to keep producing these videos. If you'd like to see similar videos in the future, then please also subscribe to the channel to make sure that you don't miss out. Thanks again for watching, and I'll see you in the next video.